Thank you for watching my presentation on why you should never focus on physician copays, but rather why you should focus on the financial features of a health insurance policy. The reason why I decided to make this presentation was because when talking about health insurance with people, I noticed that they had a tendency to fixate a little too much on what a copay for a doctor visit or prescription would be, as opposed to the financial features of the health insurance policy that they're contemplating. Now, these financial features are usually applicable to major medical, things like hospital stays, emergency rooms in some cases, outpatient procedures like non-emergency surgery or advanced imaging, things of that nature. So what are the financial features of a health insurance policy? The financial features include the deductible, coinsurance, the annual out-of-pocket maximum, and finally the lifetime maximum of the policy. The deductible, by definition, is a certain amount of money that you must meet first before coverage begins on certain services. Usually on a traditional plan, it's applicable to major medical, things like hospital stays, emergency rooms, outpatient procedures, things of that nature. In some cases, depending on the type of plan, doctor visits and prescription drugs can also be subject to that deductible, but it is important to remember that the deductible is what you must meet first before coverage begins. In most cases, it is not the most you must meet, so it's very important to make that distinction when evaluating a health insurance policy. Once the deductible has been met, you're going to be into another level known as coinsurance at this point. This is where the insurance company comes in to pick up some of the costs. It's the amount you pay and the amount the plan's going to pay, hence the title coinsurance. You might have seen this displayed in percentage like 80-20, which basically means that the plan, the health insurance company, is going to pay 80% of whatever services are rendered, and you, the beneficiary, are going to pay 20% of whatever services are rendered once the deductible has been met. The final stage of the beneficiary's responsibility is known as the annual out-of-pocket maximum. This is the most one will have to pay for major medical and in some cases doctor visits or prescription drugs in a given calendar year. It's kind of a stop-loss measure that is put in place to protect you, the beneficiary's costs from going out of control. However, an insurance company will put in place a stop-loss measure to protect themselves to keep their costs from going out of control. This is known as the lifetime maximum. It's the most the insurance company will pay out for the lifetime of a policy. When putting this together to make sense out of it, we'll use a worst-case scenario. Let's say if you're in the hospital for a month, for whatever reason, and you get released and then get a $100,000 bill in the mail. Now, before coverage can begin on this bill, if you haven't applied anything towards your calendar year deductible yet, your initial outlay right off the bat is going to be $1,500. It's at that point you've met your calendar year deductible. You do not have to worry about it again for the rest of the calendar year. We are now going to be in the cost-sharing stage that we discussed earlier, known as coinsurance. Now, the coinsurance for this hypothetical bill is going to be 20%. So that basically means that technically you're liable for $20,000 of that bill after the $1,500 deductible is met. But you have an annual out-of-pocket maximum on the plan to protect you to keep your costs from going out of control of $3,500. So when you meet your $1,500 deductible initially, you've shaved that amount off of your annual out-of-pocket maximum, leaving $2,000 to go before you max out. So after you've met the deductible, you're going to pay 20% coinsurance or an additional $2,000, whichever comes first, but never a penny more. On a cautionary note, some carriers have it where the deductible is included with the annual out-of-pocket maximum, like on the example that we just went over. And then yet other carriers have it where the deductible is not included with the annual out-of-pocket maximum, meaning you would not only have to meet the $1,500 deductible, but still have the entire $3,500 out-of-pocket maximum that you must satisfy as well. This would bring us to a total of $5,000 as opposed to a total of $3,500 on the prior example that included the deductible with the annual out-of-pocket maximum. This is a devil-in-the-detail question that you want to ask whoever is pushing a health insurance policy on you, because this is going to justify your premium a great deal. Once you understand what you're paying out if the unthinkable occurs, then you can look at things like doctor visits and prescription drugs, because a lot of that's just bells and whistles. It does not cost a lot for an insurance company to cover a doctor visit, even if you had to pay out of pocket for one. They range around $100 to $150, somewhere in that neighborhood. It's about $5,000 a night in the hospital without insurance. So needless to say, the more coverage you have on things like hospital stays, outpatient surgery, emergency rooms, the more your premium is going to be, and vice versa. I hope this presentation has helped demystify how health insurance functions. This is why when shopping for insurance, it's important to have access to a variety of carriers in order to make a more informed buying decision. Whatever your needs, I would be happy to assist you on deciding the right policy for you and your family. If you would like to compare rates and carriers, simply visit www.erickkingsleyinsurance.com for more information, or I can be reached toll-free at 888-367-5219, Monday through Friday, 9 a.m. to 9 p.m. Eastern Standard Time, and Saturday, 9 a.m. to 5 p.m. Eastern Standard Time. Again, thank you for watching, and stay tuned for more informational videos in the future.